Good afternoon, everyone. It's Monday, the 18th of December. My name is Thilan Wickramasinghe. I'm the head of research for Maybank Securities Singapore. Welcome to our final Markets Monday show for 2023. It's the last but not the least. We will be back next year, and I'll give you the details of that. But the first thing I want to talk about is the Fed's mood swings. I mean, we started last week with what was expected to be the Fed pivot with interest rates, with early interest rate cuts, and now we see them dialing this back very, very quickly. Just the last couple of days. So the markets are whipsawing because of that. So and I think the reality is that rate cuts are unlikely to happen as early as what the markets were earlier predicting. I mean, there are some bets out there saying by March 2024 you'll have rate cuts, but inflation rates are nowhere close to where they need to be for that to happen. Now, it is in a way it's good for us. It's particularly good for Singapore, which is a very defensive country, and it tends to do pretty well during high interest rates. And our economics team sees two major themes playing out next year that will be positive for rebounding growth. Next up, we're going to be talking about a small cap, which is a very high conviction idea with nearly 90% upside. And then finally, we're going to take a holiday to Thailand and find out why the hotel sector there is a buying opportunity right now. Let's, as usual, start with the market movers. Generally, green last week, mostly driven by the fact that, with the Fed pivot, earlier part of this week, we did see the Nasdaq going up about 0.4%. Interestingly, a lot of the upside that the S&P had last week, by Friday, it had already given all that up. So the S&P was fairly flat to close the week. We did see Japanese Nikkei going back up as well, up about 0.9%, mostly from the central bank. They're talking about raising interest rates. And we did see some activity coming back to Hong Kong as well, partly from the Fed pivot and deep discounted valuations there. Generally, Southeast Asia actually held up quite well, with Jakarta up about 0.2, the KLCI up about 0.4, and the SET up about 0.9. The only market that was underperforming a little bit was the STI, but we did see some selective sectors doing well, particularly the REITs last week. Now, I want to first start off with our macro view. Our macro team is looking for a rebound for next year, particularly in terms of overall GDP growth. They see two major transitions that are taking place in Singapore, and these two transitions are going to get bigger and bigger as we go into next year. The first is a political transition where we will have the current PM handing over power to the Deputy Prime Minister, Lawrence Wong, sometime before November 2024 next year. This will give the new 4G team time to prepare for the 2025 general election. What we expect is there could be a cabinet reshuffle along with that, which should give the 4G leaders much more prominent roles. We should see some hints of this along with some of the policies by February 2024, when the budget policies and recommendations come out. We expect a lot of that to include a lot of the findings from the Forward Singapore exercise that happened this year. We could particularly see areas like unemployment support, particularly pegged to employment and training, becoming quite prominent in the budget. We should see more expansion of HDB housing along with more subsidies, but with a little bit more restrictions in terms of secondary market. We should see a more progressive tax system being introduced as well. And there should be more support for lower income families as well. The second transition that we're looking at is the green transition, where Singapore is set to deploy massive amounts of capital over the next few years as they try to reduce their emissions to net zero by 2050. Now, this requires a lot of effort and work, and the sort of estimates that are out there is about 100 billion Sing dollars required for Singapore to get to this net zero position. And we've already heard some projects like the Long Island on East Coast, but we should see a lot more projects being announced as well as more alternative energy, sustainable energy imports coming into Singapore as well. Plus, you have Singapore raising carbon taxes as well next year. Now, all of this means that inflation will be sticky going into 2024. Unlike some of the other countries like the US and Europe, where you're seeing a rapid decline in inflation, Singapore may not experience it to that degree. It will come off, but you remember you still have the GST hike coming in January. We have the carbon taxes coming in January, more progressive wages as well. So Singapore's GDP, sorry, not GDP, I beg your pardon, inflation will remain a little bit more stickier. So we may see the central bank, the MAS, actually keeping overall policies the same, at least until towards the end of 2024. Now, on the other hand, GDP should actually start to rebound. We should see GDP coming in at about 2.4% for 2024, which is a big jump from the 1.1% we are expecting this year. We think that the growth also will be a lot more well balanced than what we saw in 2023, where it was mostly driven by services. And we should see a lot more support coming in from the manufacturing sector, particularly from the electronic side as the semiconductor cycle starts to pick up. Retail sales should also be better, given the strong job numbers in Singapore, as well as a lot more, also the expectation that there'll be a little bit more COE quotas coming in next year as well. Plus, construction side should also be holding up quite well. So overall, we are looking for a stronger growth year for Singapore going into 2024, even with slightly higher inflation. And this should be positive for sectors like the banks, tech manufacturing, consumer, as well as some of the REITs as well. So a lot to look forward to as we go into 2024. Now, let's get into talking about stocks now. And one of the key stocks that I want to talk about is Dyna-Mac, which is a small cap. It's an engineering and procurement company for floating production, storage, and offloading modules, the FPSOs, in the oil and gas industry. The stock has come off about 30% in the last 3 months. And now Jarek is sticking his head out there and saying that this is actually an overcorrection and that we should be revisiting this stock. So Jarek, why do you think this is the case?
Hi, Thilan. I mean, if you look at the fundamentals of the stock, the FPSO market actually is still booming. I did some channel checks across, different companies, and I think the outlook for the FPSO market is still quite robust. I think there's quite a few FPSOs that's slated to be built in the next 2 or 3 years, especially from Brazil. and I do think that Dyna-Mac could secure some of these topside modules for these projects. And if you look at what the company is doing, I mean, the company is still expanding. They just secured a new land lease from JTC, which expands capacity by 30%. I think management is still keen to expand further because of the projects they want. If you look at the current order book, their order book is currently filled to mostly to about 2025. And we do think that they could win another 200 million to 350 million of projects by the first half next year. So if you look at in terms of the fundamentals of the company, basically their revenues and profits should be covered till 2025 with about 631 million worth of projects already won in their current order book. So, you are looking at 2 clear years of clear earnings visibility and growth. Their net cash of about 50% of market cap is net cash. If you look at the at the prospects, you know, FPSO market is still strong. They're still going to win more projects. So this correction looks to be overdone, and we do think that after this 30-40% drop in share price, you know, at this valuation, it looks fairly attractive again. Yeah.
Yeah, so 50% of the market cap is cash. That's extremely positive. Now, but Jarek, what would you say would be some of the catalysts for the stock to kind of get off this downward trend and kind of push itself back up again?
So I think the market misunderstood Dyna-Mac in a way, because in third Q they didn't release their business update or business or 3Q results, but that was a strategic decision taken by the management in 2Q, that, you know, because previously they reported half yearly, but they started to report quarterly because the market was, I mean, they went through a downturn in business, so they wanted to give shareholder assurance that, you know, quarterly how are they doing to the company, whether the company is improving or not. But now that the order book secure all the way until 2025 and outlook prospect looks good, they don't they change it to half yearly, because they do see that, you know, sometimes the contracts and the orders are done and they cannot close, you know, they close after the quarter, and it will have a big difference in terms of quarter on quarter results, but actually on year it's still a growth. Yeah, so
Yeah.
we do think that the next catalyst will be earnings. We will report in February of next year. That will be their year-end 2023 results, which we do expect profit growth to be about 50% year on year from 2022, which we do think that will be a catalyst. Next, we also do think that they'll reward shareholders with more dividends, given their good financial performance. And lastly, you know, management has always highlighted that they want to do M&A, and they want to do inorganic growth to add on to their recurring income revenue. So they are looking to add maintenance business to their revenue rather than just one-off projects. So we do think that, you know, if there's an M&A that's coming on next year, that could be a good catalyst as well, because that could convert some of the cash to core earnings. And these core earnings will be valued at a higher PE. So actually, just in fact, today actually Dyna-Mac announced that they had a bonus warrant issue, and that will raise about 30 over million for further expansion. And we do think that this will also be used for, the cash will also be used for M&A, that the plans that they have for next year. So all in all, we do think that, you know, outlook is still good for Dyna-Mac, and these are the few catalysts that could help to re-rate the stock further from these levels.
Okay, strong outlook. Watch out for the February full year results. And I think, yeah, absolutely. I think the valuations are cheap. 50% market cap is cash, 50% earnings growth, order book secured till 2025. I think some very, very strong prospects for this company. So this is one of our high conviction buy ideas going into next year. Thanks, Jarek, for joining us. Now it is the end of the year, and I'm sure a lot of people are thinking about their holidays and taking some time off. So I thought, what best way to think about holidays? You can't think about holidays unless you think about Thailand. But as a market, though, Thailand has been one of the worst performing Southeast Asian markets this year, down about 20% in US dollar terms. But I have our Thai hotel analyst, Bunyakon, who says that, despite all this, it's actually time to be positive on the Thai hotel sector. So Bunyakon, welcome to the show.
Hi.
Hi. We can't see you. Can you switch on your camera, please, Boon?
I think we have some problem with the camera.
Oh, okay. All right. No worries. Okay, Boon, you just initiated on the Thai hotels with a positive outlook. Now, this to me sounds quite counterintuitive since there's a lot of news that, the Chinese tourist arrivals into Thailand are not particularly growing. So what's driving your confidence?
Okay. First of all, I think we are quite positive about the sector because I think it's less rely on the Chinese recovery compared to like the airport and the airline. I think hotel earnings next year, 2024, I think is I think one of the best in the service sector. we forecast overall for the hotel about 21% growth in 2024. If you look it back in 2019, right, the room revenue for all the listed hotel operator, right, they rely on Chinese only for 15%. So if as long as other market are doing well, I don't think we should I think we are fine with the hotel recovery. Apart from the demand, I think the margin is also in a recovery trend. So that's why sector and earning is going up. Yeah.
Okay, so can you talk a little bit more about the demand supply situation for the hotel rooms in Thailand? How is that going to change over the next couple of years?
Okay. As you know that the foreign tourists in 2024, I think we will not come back to the pre-COVID, but it's probably about 85% to 90% of uh, the pre-COVID next year. So demand is going about, let's say 20%, 25%. But I think supply, if you look at the supply side, let's say Bangkok, right? The pending room that we going to the supply is probably about 11%. So I think demand is still outpacing supply in at least in 2024. If you look at one more forward year, let's say 2025, I think supply is going very low, let's say 3 to 5%, especially in the Bangkok. Yeah.
Okay, got it. Got it. What is your top pick, Boon, and why?
Okay. I'm looking at the valuation attractiveness and earnings growth in 2024. So we picked the minor international, the Mint. Current valuation is at 20 times PE. Growth next year, EPS we forecast at 18% in 2024. So I think it's quite a good time for entering the stock at this attractive valuation. Corporate demand in Europe, let's say Mint have 60% in revenue in Europe and other is in Thailand and like Middle East and Oceania. So we see of the degree of diversification. So and we hope the corporate demand in Europe is coming back too, which is 2023. We haven't seen the full recovery yet. So demand is still strong and margin is still expanding and CapEx is back to the cycle that they invest in the new hotel. So we're not concerned about growth after the high base. I mean, okay, this year is a high base for Europe hotel, but next year there's a new upcoming hotel to come online. So adding up with the Thailand portfolio, they're still in recovery mode. So we think is a earnings to uptrend.
Right. So recovery in Thailand, more capacity in Europe, all coming into play next year for Minor International. Okay, that's interesting. Boon, any other stocks that we should be keeping an eye on?
Okay. We have a stock that we recommend buy too. It's Central Plaza Hotel, which is mostly based in Thailand. Okay, we are quite positive about Thailand tourism next year too. So Central have we forecast EPS growth to go 42% in 2024 and 37% in 2025. That's a very high growth. But the PE now is about 35 times. So if we convert it to PEG, that's like 1.1 compared to the sector at 1.7. So it's a high growth, but it's come from the low base. Low base is because of this year they have a lot of renovation, the hotel renovation in Thailand, and the food business margin are not doing good. And also they have the new hotel opening in Japan. Cost is coming first, but I think revenue is coming in next year. So I think it's from the low base and earnings looking forward 2024. We think it's the highest growth in the sector. So we pick Centel 2 as a buy.
Got it. Centel as well. And what are the downside risks, Boon, that we should be looking out for?
Okay. We see Chinese tourists as the upside from my view. But if other market are not doing well like Europe, let's say they have a recession and they might cut traveling spending, right? That's might affect the demand of the Thailand tourism. The other thing is cost. Cost is we monitor it, it's going down, but certain costs like labor cost is still it still have the concern over the labor shortage issue in Thailand. So we don't think it's much downside for it.
Got it. All right, thanks for that. I think very exciting prospects for Thai hotels going into 2024. And we've got Mine International as our top pick, as well as Centel as well. So please do look at that report. It's a very detailed report in our newsletter. Thanks, Boon, for joining us. Now, with that, I know we are kind of running out of time. There is a comment in the Q&A box. I did promise our audience that we will have a little bit more discussion on China in our show at the end of the year. Unfortunately, this is the time of the year when a lot of the analysts are traveling as well. So we haven't been able to get all the analysts that I wanted to put in front of our audience together. But please do join us early next year, and I promise that we will have a very comprehensive discussion on that market on our Market Monday show. Just in terms of dates and updates, we've got a few. It's not a very busy week going into next week, and I think it will not be very busy for the next couple of weeks. We got the balance of trade numbers out on today, as well as CPI and industrial production numbers out 26th of December, and then the bank loan numbers come out on the 29th of December. Now, I want to make a special personal note to say, thank you so much for supporting us and joining our Market Mondays show week after week for the past few months. It's your participation that encourages us to put this show on. So please do continue to join us going into next year. Thank you so much again for your support on behalf of everyone in the team for 2023. And we look forward to seeing you back again on the 8th of January for our first Market Mondays for 2024. Until then, have a restive holiday, a great and joyful season with your families. And Happy New Year for 2024. Thanks for joining, and have a profitable week.